studying your last two. I swim med when they turned in. The staring down to mute. And can land a pole that sunk he died.
When a corporation has a tax loss for the current year, many people immediately think about carrying that loss forward to reduce taxes in future years. While that is one option, it is not the only one. Another important strategy is called a loss carryback. A loss carryback allows a corporation to apply an eligible current year tax loss against taxable income earned in certain prior taxation years, subject to the rules of the Income Tax Act. If the corporation paid income tax in one of those earlier years, applying the loss may reduce that prior year's taxable income and result in a tax refund. Let's look at a simple example. Suppose that in year 1, a corporation had a profitable year. It earned taxable income and paid corporate income tax. Then, in year 2, business conditions changed, and the corporation incurred a tax loss. Instead of waiting to use that loss in a future profitable year, the corporation may choose, if the rules permit, to carry the loss back to year 1. The loss is applied against the taxable income that was previously reported in that profitable year. Because the prior year's taxable income is reduced, the amount of tax that should have been paid for that year also decreases. As a result, the corporation may become entitled to a refund of some of the income tax it already paid. This is why a loss carryback can provide an immediate cash flow benefit. Rather than waiting for future profits, the corporation may recover taxes that were paid in an earlier year. You can think of the process as 4 simple steps. First, the corporation incurs a current year tax loss. Second, the corporation reviews its prior profitable years to determine whether a carryback is available under the tax rules. Third, the eligible loss is applied against prior year taxable income through the appropriate tax process. Finally, if the application is accepted, the corporation may receive a refund of taxes previously paid. One of the most common misunderstandings is believing that every tax loss must always be carried forward. That is not the case. Depending on the corporation's circumstances and the applicable tax rules, a current year loss may sometimes provide a greater benefit by being carried back to recover taxes already paid. The key idea to remember is simple. A current year tax loss does not always have to wait for future profits. Subject to the rules of the Income Tax Act, it may be applied to eligible prior taxation years, reducing prior year taxable income and potentially generating a tax refund for the corporation. When a corporation has a current year tax loss, the next step is deciding how that loss should be used. One option is to carry it forward to reduce taxes in future years. Another option, if the corporation qualifies under the tax rules, is to carry the loss back to a prior profitable year. Let's walk through the carryback process step by step. The process begins when the corporation prepares its current year tax return and determines that it has an eligible tax loss. Once the loss has been identified, the next step is to calculate the amount that is eligible to be carried back. This calculation is based on the applicable provisions of the Income Tax Act and determines how much of the current year loss may be applied to an earlier taxation year. After calculating the available loss, the tax preparer reviews the corporation's prior year tax returns. The objective is to identify years in which the corporation earned taxable income and paid corporate income tax. These are the years that may benefit from a loss carryback. Next comes an important planning decision. The tax preparer determines how much of the available loss should be carried back, depending on the corporation's overall tax situation. It may be appropriate to apply all of the eligible loss or only part of it. Once that decision has been made, the carryback is reflected through the appropriate tax process. and Schedule 4 is updated to record how much of the loss has been applied and how much remains available. When the carryback reduces the taxable income of the prior profitable year, the corporation's tax liability for that year is also reduced. If too much tax was originally paid, the corporation may become entitled to a tax refund. Now compare the two possible outcomes. Without using a carryback, the corporation keeps the loss for future years and waits until it earns taxable income before receiving any tax benefit. With a carryback, the corporation may receive part of that benefit immediately by recovering taxes that were already paid in a previous profitable year. Both approaches are valid. The best choice depends on the corporation's financial situation, future expectations, and overall tax planning strategy. One common misconception is believing that every corporate tax loss should automatically be carried forward. In reality, tax preparers should always evaluate whether carrying the loss back could provide a more immediate benefit through a tax refund. The basic idea is easy to remember. A current year tax loss may reduce future taxes through a carry forward, or it may reduce prior year taxes through a carryback, provided the applicable tax rules are satisfied. Understanding both options allows tax preparers to recommend the strategy that provides the greatest benefit for the corporation, while ensuring Schedule 4 accurately reflects how the loss has been applied. Before deciding to carry a current year tax loss back to a prior year, a tax preparer should always complete a careful review. Although a carryback can provide an immediate tax benefit, it is important to confirm that it is the most appropriate strategy for the corporation. The review begins by confirming that the corporation actually has a current year tax loss available. Once that loss has been calculated, the next step is to review the corporation's prior year tax returns. The objective is to identify previous taxation years in which the corporation earned taxable income and paid corporate income tax. A carryback is only useful if there was taxable income in an eligible prior year that can potentially be reduced. After identifying those years, ask a very important question. Did the corporation actually pay income tax during those years? If no tax was paid, carrying the loss back may not provide an immediate benefit. However, if tax was paid, reducing the prior year's taxable income could result in a refund of some of those taxes. Next, evaluate whether a carryback is the best overall option. Would applying the loss to a previous year generate a valuable refund today? Or would it be better to preserve the loss and carry it forward to offset taxable income in a future profitable year? The answer depends on the corporation's overall tax position, expected future income, and tax planning objectives. Once the decision has been made, update Schedule 4 to record how much of the loss has been applied and how much remains available for future use. If the corporation qualifies for a refund, the appropriate claim is prepared as part of the tax filing process. As you perform this review, ask yourself several practical questions. Does the corporation have a current year tax loss? Which prior years had taxable income? Were taxes actually paid in those years? Would carrying the loss back provide a meaningful benefit? How much of the available loss should be carried back? What balance will remain after the carryback? And has Schedule 4 been updated accurately to reflect the remaining loss balance? To answer these questions, you'll typically review the current year T2 return, prior year T2 returns, Schedule 4, the corporation's financial statements, tax working papers, and your supporting calculations. The most important lesson is that every loss should be evaluated before deciding how it will be used. A professional tax preparer doesn't automatically carry every loss forward or carry every loss back. Instead, they compare the available options, estimate the tax benefit of each approach, and select the strategy that provides the greatest overall value for the corporation. The simple rule to remember is this: before carrying a current year loss forward, always consider whether applying some or all of that loss to eligible prior taxation years could provide a more immediate tax benefit. Review prior year taxable income. Verify that taxes were previously paid. Document your analysis, and update Schedule 4 accurately to reflect the final decision. Following this review process helps ensure that corporate tax losses are used effectively, tax refunds are not overlooked, and the corporation receives the maximum benefit available under the Income Tax Act.